If you own a basic NASDAQ index fund, the kind everybody tells you is the safe, boring, set it and forget it choice, there's a decent chance that within a few weeks, you're going to own a slice of an unprofitable $2 trillion rocket company, and nobody's going to ask your permission. I'm not exaggerating, and I'm not trying to scare you. There's a mechanical reason it's about to happen. Almost nobody is explaining it in plain English. And once you see it, you can't unsee it. So let's talk about the biggest IPO in history and the part of it that actually matters for your money. Quick hello, I'm Jason Hilliard. This is the Limitless Wealth Method podcast, where I say things about markets I think entrepreneurs, executives, and investors actually need to hear without the jargon. If that's useful, please stick around. One idea today: SpaceX just went public. OpenAI and Anthropic are right behind it, and the way these three are hitting the market could ripple into a portfolio you thought had nothing to do with any of them. Here's the setup. On June 12th, SpaceX went public. It's the largest IPO ever by a mile. They priced it at $135 a share and raised about $75 billion. For scale, the previous record was Saudi Aramco back in 2019, and this blew past it. The stock opened around $150. It touched the 170s on day one and closed up about 19%. Then in its first full trading day, it jumped another 19 or so percent. So as I'm recording this, it's run from roughly $150 to nearly $220 in a matter of days, putting the company north of $2 trillion. Demand was so heavy, the underwriters exercised what's called a green shoe, basically an option to sell extra shares, and the raise climbed to about $85.7 billion. On paper, Elon Musk briefly became the world's first trillionaire. And one detail to keep in your back pocket because it matters later: SpaceX isn't actually profitable yet. The piece that makes money is Starlink. But SpaceX isn't the whole story. It's the first of three. OpenAI and Anthropic, the two biggest names in frontier AI, have both filed paperwork and are expected to go public this year, reportedly targeting the fall. So inside a single calendar year, you've potentially got three of the most hyped companies on the planet all going public. And here's the question almost nobody asks at the dinner party level: where does the money come from? Because when investors pile hundreds of billions of dollars into brand new listings, that cash isn't created out of thin air. It comes out of things people already own. And the most likely source is the stuff that's been carrying the market for years: the Magnificent Seven, the big tech names. So even if you never buy a single share of SpaceX or OpenAI or Anthropic, you could feel it as a headwind in the positions you already hold, because money is quietly rotating out of them to make room. Some serious people are worried about this. Research shops have warned these three could swallow the entire pie of this year's public listings. One big bank framing the whole wave as a large-scale transfer of risk from early insiders to the public, which is typically something a lot of banks say whenever there's a large IPO. So I don't really put much credence into that. And the timing is unusually concentrated: one in June, two more in the fall, which is exactly the recipe for a liquidity squeeze. Now, and this is important because I'm not here to sell you doom. There's a real argument on the other side. The banks underwriting these deals say that impact is totally manageable. And they have a point. There's something like $8 trillion sitting in the money market funds right now. Against that, SpaceX's $75 billion raise is about 1%. There is, in other words, plenty of dry powder on the sidelines. So the honest framing isn't the market is going to crash. It's a tug of war. You have forced selling to fund the IPOs on one side and a giant pile of cash on the other. The question is, which one wins and when? Here's where I'll put my own cards on the table. And I want to be clear, this is my hypothesis, not a prediction carved in stone. I think we might see this play out as three separate stress tests on the market, not one. SpaceX was the first experiment. And so far, demand overwhelmed everything, but we did see a dip in the market prior to SpaceX going public. OpenAI and Anthropic are still to come. Each one is another moment where the market has to find tens of billions of dollars fast by selling something else. So my plan isn't to guess the outcome. It's to watch the next two like experiments. We just ran the first one. What happens to the broader market in the weeks around the next two tells us whether this crowding out idea is real or just a scary story. That's the kind of thing I'll keep coming back to on this channel as it unfolds. Now we get to the part that's genuinely controversial, and the part most people get slightly wrong, so let me be precise. The exchanges didn't change the rules to let these companies go public faster. They changed the rules around how fast a new company can get added to the major indexes, the baskets that index funds and ETFs are forced to track. Here's the normal way it works. When a company goes public, it usually has to season for up to a year before it's eligible to join a big index. That waiting period exists for a reason. It lets the market actually figure out what the stock is worth, and it protects passive investors from getting shoved into an untested, thinly traded name. To win the SpaceX listing, NASDAQ was competing with the New York Stock Exchange for it. NASDAQ relaxed that rule. Under the new fast entry pathway, a company of this size can join the NASDAQ 100 in as little as about 15 trading days instead of waiting a year. The S&P 500, to its credit, kept its 12-month seasoning rule. So the two big indexes went different directions. And plenty of respected people think the NASDAQ move is a bad idea. A famous investor, the one a lot of people know from The Big Short, flagged the criticism publicly. Another Wall Street veteran called it, and I'm quoting one word, shameless. Their argument is you're forcing passive index investors to buy a brand new, barely floated stock before the market has had any time to price it honestly. So let's bring it home to you, because this is the whole reason I wanted to make this episode. If you hold a NASDAQ tracking index fund, a QQQ, or something like it in your 401k, you don't pick what's in it. You own whatever the index owns. The top handful of names already make up close to half of some of those funds. And because of that fast entry rule, a stock like SpaceX could land in your safe, diversified index fund within weeks of going public. You think you don't own an unprofitable $2 trillion rocket company. If you own the wrong index fund, you might in a matter of weeks, and nobody asked you. That's not a reason to panic. It's a reason to actually look at what you own. The whole promise of passive investing is you don't have to think about it. This is one of those moments where thinking about it for 10 minutes is worth it. Know whether your index fund seasons its additions or fast tracks them. That one question tells you whether you're about to get mechanically handed a piece of the most speculative IPO in history. There's one more layer here, and it's the part I find most fascinating because it ties everything together. SpaceX did something unusual with this IPO. Most giant IPOs treat regular individual investors as an afterthought. They hand them maybe 5 to 10% of the deal and give the rest to the big institutions. Musk wanted to flip that. He originally aimed to set aside around 30% of the offering for everyday retail investors, his fan base basically, roughly triple the norm. It got trimmed down to the low 20%, but not because demand was weak. It was actually the opposite. Institutional demand was so overwhelming, they had to rebalance. Retail orders alone topped $100 billion. Total demand blew past $250 billion. Fidelity dropped its minimum to get in from as high as $500,000 down to $2,000, basically throwing the doors open. And to make the loyalty thing stick, the brokerages put anti-flipping restrictions in place, so people couldn't just grab shares and immediately dump them. Now, here's the math that makes it wild. This is a $2 trillion company, and it only floated about 4% of itself to the public. 4%. And within that tiny 4% slice, about a fifth went to retail. So you've got a devoted fan base being handed a piece of silver and told not to sell. And that's where it connects back to the index story. The day after it listed, an index inclusion kicked in that forced certain funds to buy the stock. And those funds buy regardless of price because their only job is to match the index. So you've got a perfect storm pushing the price up: a tiny float, a loyal retail base that's been told to hold, and index funds mechanically buying what's ever left. Which leaves the real question I want you to sit with. When a stock runs from $150 to nearly $200 in a few days, how much of that is genuine conviction in the company, and how much is just plumbing? Forced buyers and locked up sellers? Because those two things look identical on a chart, they do not feel identical when the forced buying stops. Let me zoom out and be fair about the backdrop, because context matters. The broad market is expensive by historical standards right now. Valuation measures that people watch are up near levels we last saw around the year 2000. SpaceX itself is being valued at something like 90 plus times its revenue, several times richer than even the priciest of the big tech names. And again, it's not yet profitable. Starlink is carrying the financials. On the AI side, there's a detail worth knowing. Ahead of OpenAI's listing, hundreds of current and former employees reportedly sold billions of dollars of stock on the secondary market. Insiders taking money off the table early isn't automatically a red flag, but it's worth noticing. And banks are reportedly working on staggered lockup plans, specifically so a flood of insider selling doesn't tank these stocks after they list. None of this tells you what happens next. Markets have stayed expensive for years now, but it tells you the margin for error is thin, which is exactly when knowing what you own matters most. So here's what I'd leave you with. This isn't a story about whether SpaceX is a good company. It clearly does astonishing things. It's a story about market structure, about plumbing, and about the quiet ways that safe and passive can turn into concentrated and speculative without you lifting a finger. The move isn't to panic sell anything. The move is to look, know what's in your index funds, know whether they season or fast track, and keep watching the next two IPOs as the real tests. If this was useful, do me a favor, follow the channel, because I'll be tracking how this whole thing plays out as OpenAI and Anthropic come to market. You can find everything we do at limitlesswealthmethod.com. Links will also be in the description. I'll see you on the next one, but a quick and important disclaimer: everything in this video is for education and information only. It's not investment advice, and nothing in here is a recommendation to buy or sell any specific security. I'm not making predictions. I'm thinking out loud about market structure. Talk to your own investment advisor before you do anything with your money. I appreciate you listening, and we'll see you on the next one.